Closing the books is a manual, error-prone, and time-consuming process. In fact, 82% of accountants find the month-end close to be a negative experience. 78% report having to reopen the books, and 3 out of 4 say they're not confident in their close. Meanwhile, management wants numbers faster than ever, and investor scrutiny on financial reports has only increased. There has to be a better way than email, Excel checklists, and endless status update meetings. Flowcast was built by accountants for accountants to help them close faster and more accurately. It provides a single place to manage the month-end close, aligning people, processes, and documents in one collaborative platform. The bottom line, teams relying on Flowcast on average close 3 days faster. Learn more at cloudaccountingpodcast.com/flowcast. That's FLOQAST. Welcome to the Cloud Accounting Podcast. I'm Blake Oliver.
I'm David Leary.
Did you hear about Amazon and their new experiment, retraining their workforce?
Did not hear about this.
I mean, I'm a big Amazon fan. I get Amazon boxes every day, of course. So I love automation and technology, and I just think they're one of the coolest companies in the world. Well, Amazon is going to be spending $700 million to retrain about a third of their American workers to do more high-tech tasks. This was an announcement that happened this past week. They're going to retrain 100,000, or they're aiming to retrain 100,000 workers by 2025. And they have 300,000 employees in the US. So that's a lot of people.
And the reasoning on this is they need to grow and they can't hire another 100,000 people. It just makes more sense to get everybody working highly efficiently.
Well, so that's the really big question, right? And so, of course, the reasoning, or the number one reason I think of is, Amazon is on the forefront of automation. I mean, if you've seen any of the pictures of their warehouses or the videos of how they work, they are super automated. They're some of the most automated warehouses in the world, with robots bringing packages. There's still humans packing the packages, but they have a lot of robotic assistants. And if Amazon continues this trend, if they manage to fully automate these warehouses, right, that's a lot of workers that are going to be out of work. And so they need to upskill their workers, to use a popular term these days. And so the program's goal, it's not going to be to turn these warehouse pickers into software engineers. The program is aiming to move these workers who are, say, picking items and putting them in boxes, move them up 1 or 2 rungs on the skills ladder, and turn those floor workers into IT technicians or low-level coders, get them able to maintain these robots.
Got it. So similar to, our space, right? Like a typical bookkeeper who historically is just on data entry doesn't need to become a CFO and do advising, but they need to know, hey, I need to be a cloud accountant, and I also need to know a bunch of apps. I know how to connect the pipes. I need to know how to troubleshoot if a connection between 2 apps doesn't work. Kind of changing that skill is a level up.
Yes, you nailed it. And that's why, you and I laugh a lot of times about when there's all this talk about moving to advisory, right? And there's people out there telling bookkeepers they need to become advisors. And I feel like that's ridiculous. It's the same thing as telling a warehouse worker that they need to become, a logistics COO, right?
Okay,
it's not realistic. It's not going to happen. So yeah, this is kind of cool. The only thing, the cynic in me though, this was by the way, I'm reading from an article in the New York Times called "Amazon's Latest Experiment: Retraining Its Workforce." The thing is, at the end of the article, a guy named Mark Murrow, who's a senior fellow at the Brookings Institution, is quoted. He recently wrote a report on automation and the workforce, and he said that increased training would, like higher wages, benefit workers. But he cautioned that there's no guarantee these policies would actually last. And he said that if Amazon did, in fact, expect large job cuts in the future due to automation, offering training now would be a very savvy public relations move. So that's the cynical take, is that Amazon is saying we're going to retrain 100,000 workers when they really have no expectation that this is actually possible. Right. And they're just really going to end up automating the jobs, but they'll at least have tried to retrain the workers.
So you're arguing it's the press. They're getting the headline. Because if they lay off 100,000 people and they say, hey, but don't worry, we're going to retrain some of you, it's better just to lead now with the clean, we're going to retrain 100,000 people, and there's no negativity. So 3 years later, if they lay off 20,000. Yeah,
exactly. So if you're a big accounting firm and you're also on this automation trend, then get ahead of it, right? Say, we're going to retrain all of our staff accountants. And then, when you do ultimately lay them all off because you don't need them anymore, then, you don't get that bad press.
Great. Next week, we're going to have 5 articles all with the same headline. Perfect. You've set up the poor expectation on that.
Yeah.
Oh, man.
But I've got more on this. Like the reason
really?
Yeah, I've got more, accounting talent shortage stuff. Like you said, this is related to accounting, right? Because we're an industry or profession that is being automated heavily right now. Dan Hood wrote a great article in Accounting Today called "The End of the War for Talent," summarizing a lot of the discussion about the talent shortage and automation, and putting it in a really succinct way, or I should say, he, in a very succinct way, describes the sort of disconnect between these two concepts, in that we have a really tight labor market for accountants. The employment overall in the US is below 5%. Unemployment in accounting is around half that. There's demand rising faster than supply, giving professionals more options than ever. Salaries are starting to rise. Firms are struggling to fill positions. Firm leaders report recruiting and retention among their top concerns. So, this seems like it would be a great thing for accountants, right? But there are these other factors that are pushing the labor market in the opposite direction, and reducing demand, which is outsourcing, right? It's getting easier and easier to outsource work. Our friends at TOA Global or TOA Global would definitely agree with that, right? It's getting easier to automate work. That's the whole Amazon thing. That's the whole automating data entry kind of thing, right? Hey, there's auto entry, right? You don't need to key that stuff in anymore. Remote work is getting more prevalent, so you can expand your pool of job candidates, and more non-accountants are becoming important in CPA firms, or we're recruiting more non-accountants. So those factors kind of are balancing each other. And Dan Hood's argument is that, I think, if I'm summarizing it correctly, is that, yes, there is low unemployment, but that outsourcing and automation are going to offset this. And if so it's a wash. It's just a wash at the end of the day. Yeah. So there's this tension, and they're going to balance each other out. So the low unemployment drives the automation, but then the automation, drives layoffs. Basically, you just don't want to be one of those employees who gets caught up in the I don't know where these two friction points meet, right, and gets ground into dust. There's a lot of people, like we discussed last week, right? The Walmart layoffs, the United layoffs of accountants. I think that there's a lot of accountants who are just not really paying attention to automation that are potentially going to get swept under by all these trends. Just more evidence, I think, that this is not just an accounting thing. This is in all industries: tech, accounting, retail, manufacturing. It's all being affected by automation. And if we're upskilling and we're learning to manage these robots or RPA tools or whatever they are, we're going to be in a good spot. So that's the connection to accounting.
Yeah, because if you're not going to where the shift is headed, you're going to be impacted by it. You're not controlling your destiny ultimately.
Yep. And there's one other story that is in this theme.
Okay.
Which was a kind of a clickbaity title, a story in MarketWatch. Companies use this creative trick to keep wages stagnant even in a strong economy. What a clickbaity finance article, right?
What strategy are they using?
Yeah, you want to know, right?
You want to click on it.
Yeah, so it's not a trick, of course. It's just that the point of the article is that many companies are leveraging technology to eliminate layers of middle management. Think of companies like Zappos are cited. There's some other examples in here of and middle managers are some of the first people to go in a recession, right? Because they don't directly produce anything, and they aren't executives. So,
you could look at a lot of apps now that are helping that process, right? You can look at the Asanas of the world and the Trello boards and Slack and that stuff as it stacks up. The communication, you don't need a manager telling another manager telling a manager, because you can just get it summarized. Yeah, right. And everybody has access to the information. A lot of middle management is just taking in information and communicating it to other people, right? Mm-hmm.
So technology eliminates the need for as many middle managers. And so I love that I saw this is because it answers a question for me that I've had in my head for so long, which a lot of economists have been asking, which is how can wages be stagnant when the job market is tight, right? If unemployment goes down, wages should go up, but that hasn't happened at the same rate. The economy added 224,000 new jobs in June, right? But wages have just sort of like gone up 3.1% on an hourly basis over the last 12 months, which is not that great. Should be more, apparently, when the economy is at full employment. And so that's the reason is companies are flattening their organizations. There's basically, upper management and there's workers. And so, that is what's depressing wages overall. This is the Amazon effect, right? Which is that Amazon's a company where they have hundreds of thousands of workers, but most of them are just making not a lot of money on an hourly basis working in warehouses. But the ones who are programming the Amazon website or the apps or running AWS or they make many times as much money as those hourly workers. So it's the hourglass economy that we're hitting. It's both troubling, also exciting if you can get into that group that is building all the tech or is managing all the tech, or if you're an accountant who is leveraging all the tech. It's very exciting because there's a lot of potential, but it's creating a lot of disruption and limiting opportunity for people who don't have those higher level skills.
Well, I think it's just efficiency, right? Like companies have got to be as efficient as possible. And if you have 3 layers of middle management that may not be contributing to the actual production process, if you want to think about it that way, of course, those positions are going to get eliminated over time.
Well, if it's possible, right? Yeah, and the tech allows it to happen. So, yeah. Yep. So that is my my 3 articles that are all tied to talent this week.
So I have one that's kind of connected. Microsoft Teams. So we've talked about Slack a lot. You and I use actually Slack to talk during the week about the podcast. We actually use Slack. Microsoft Teams is now bigger than Slack.
Oh, yeah.
They have 13 million daily active users. And the growth curve is really fast because that started like December of 2016 and Slack goes back to 2013.
Well, but is that really fair given that Microsoft is shoving Teams down everyone's throat if they already have an Office subscription?
Well, so that's okay. this right?
Yeah.
That's one of the arguments I read about this. So for the last 3 years, Fortune 500 and companies have been migrating their entire systems over to Office 365, right? And they've moved everything to Microsoft's cloud. And so they don't want to go and get another piece of software and implement that when they can just turn on Microsoft Teams and it integrates beautifully with all their other stuff.
Yep.
And the reason I think this is important for us, I know we've talked about Slack a lot, but for people that haven't done it, I know lots of our listeners and lots of accountants and bookkeepers out there are on the Microsoft 365 stack.
Yeah.
And so this could be, you could flip it on and you could start getting some efficiencies with your team.
Yeah.
You could eliminate a whole layer of middle managers.
Seriously. The people who spend all their day just receiving emails and sending emails, those people are getting replaced by apps like Microsoft Teams, or at least their lives are getting better.
This episode of the Cloud Accounting Podcast is sponsored by AutoEntry. By using AutoEntry, you can stop typing data into your accounting system. AutoEntry can turn your stack of paper, be it bills, receipts, bank statements, sales invoices, and vendor statements, directly into transactions posted into QuickBooks, Sage, or Xero. Regardless of your small business client engagements, once-a-year tax-only engagements, write-up or catch-up work, monthly bookkeeping that you do in-house, a client doing bookkeeping themselves, AutoEntry is the perfect fit for all of them. AutoEntry can even handle the tricky details like line items, billable costs, customers, jobs, classes, employee expenses or reimbursements, even multi-currency. To learn even more about AutoEntry, head over to cloudaccountingpodcast.com/AutoEntry. That is cloudaccountingpodcast.com/AUTOENTRY.
You want to stay on app news?
Okay.
Have you heard about this app called Robinhood? Have we talked about that?
That's like an automated investment app type thing. It's all web-based. It's like Nubank, right? They're not a true securities company in the same way Fidelity or Merrill Lynch is, something like that.
I don't think they're a bank at all. They're one of those apps that wants to disrupt investing, right? And your 401k and whatnot. So like if you're a millennial and you haven't saved anything for retirement, you download the Robinhood app, connect your account and start investing today. And they are super hot. It's a no fee stock trading app. That's where the name Robinhood comes from because you don't pay anything.
Okay.
And so you can just start investing. Like I want to buy stock. I can go do that. I can be stupid and not invest in an index fund, right? This is just such a ridiculous story. So Robinhood wanted a hot new feature. This is detailed in a Business Insider article. The link is in the show notes, but just be warned that it's a Prime Business Insider article, owned by Amazon, by the way. And you have to have a subscription to read the full article. But you can read the summary, which I read, without having the subscription. So anyway, the summary is that they wanted a hot new feature to attract more customers. So they created a product called Checking and Savings. And they promised an industry high interest rate of 3%. Can you imagine getting 3% on your savings account, David?
That would be amazing.
Yeah, it's ridiculous, right? Nobody does this. I saw this when they advertised it, and I said, this can't be true. This will not be around. Well, less than 38 hours after the launch, they scrapped it completely. The whole checking and savings thing scrapped completely because apparently they had promised that the accounts were insured, but they didn't actually do that. Like, the FDIC insurance.
Okay.
So they're telling everybody that it's insured, and nobody at the company checked to make sure that anyone had actually done it. There's a quote in the article. Apparently, Business Insider spoke to 10 former Robinhood employees, and one of them said, when it came to the checking and savings launch, sources said the decision to not reach out to the proper authorities was a deliberate one. When warned by his team, a former executive tells Business Insider that co-CEO Baiju Bhatt's response was, quote, "F it, we're doing it anyways."
But the difference is, you think about Uber, right?
Yeah.
Uber just started launching markets illegally, right?
Yeah.
Bird and all those scooters are everywhere.
Yeah.
Like they just go and dump them on the sidewalks, and then we'll figure it out after the fact when we get in trouble for it. But it's different because there's not this thing called the SEC involved, right? And stocks and banks is a whole different game. You can't do that same launch strategy. Like this is going to bite these guys.
And they had to shut it down within 48 hours. Like it did not fly. Like this whole break it and then fix it later. Yeah.
But I wonder if it'll affect the rest of their service. Like, is this going to really impact their whole everything now?
Well, now that they're on the regulator's radar for sure. Like if they were doing that kind of stuff, telling people that your checking account is insured when it's not. Yeah. I mean,
like, what else did you guys say? Just F it and skipped.
Yeah.
Yeah. That's a good find.
You got any app news?
I got a Bill.com.
All right.
App news. So remember, I feel like it was about 4 to 6 months ago, Bill.com launched their multi-currency and international payments.
Very exciting. Yeah.
So they basically just had a kind of a press release saying that they've now, since the beginning of the year, their payment volumes increased 124%, and the monthly transactions for international is up 135%.
Wow, that's so very successful.
Yeah, and there's the average company is saving about 32% on the cost of doing wire transfers. Or historically what was a wire transfer, but now moving the money through Bill.com.
Well, and I think the fee, like what Bill.com's fee is something like $10 to do a wire or the equivalent of a wire. It's very low compared to like 30 or 40 that you're paying a bank typically.
Let me scroll through the article here because I feel like they said it was no fee.
Oh,
there's no wire transfer fees, and the exchange rates are competitive. So obviously you have to subscribe to Bill.com, but I wonder if there's some other.
It's interesting. Like international payments, it's so difficult to know how much you're actually paying because they may say there's no fee, but then what are you getting in terms of the exchange rate, right? And that's where they make their money is on the split between what they pay and what you pay. So, but I'm just going to say like it's got to be cheaper than what the banks are doing because the banks just rip us off.
Yep.
I got some fundraising announcements that we may have missed over the last few weeks. So MindBridge AI, they raised $11 million in a new funding round from the Canada Strategic Innovation Fund, which is earmarked to accelerate the development of artificial intelligence technology. This $11 million adds to the recent Series B funding the company received. And I guess the total they have raised now is $34 million. So this is I see MindBridge around a lot, or at least I see their articles around a lot. They're really out there talking about artificial intelligence in audit.
Yep.
And their flagship product, which I've never seen, I would love to know more about it, is AI Auditor, which they released in 2017. And they say they've grown pretty fast. They have more than 260 customers in 14 countries, and they've tripled the size of their workforce since 2017.
Wow. So that's a decent investment, and it looks like they keep, they're adding customers. So
keep that on your radar. Yeah.
Yep.
Another one here, Cabbage. We've talked about Cabbage before, right? Integrated loan platform. So yep. I can plug it into my QBO, right? If I
so I mean, essentially the it's another one of those instant loan players, right? It reads your QuickBooks data. They really, when they started, were targeted at inventory companies, right? Mm-hmm. You can't buy if you're retail, especially, right? You need to buy a bunch of inventory in November, but it's hard to go get that loan, so you have the inventory to sell in December. And so they really start getting into that space and looking at the QuickBooks data historically to offer loans that traditional banks would not give.
I didn't know that they're a unicorn. They were last valued at $1.2 billion in 2017. They have raised about $500 million in equity to date. And the announcement on TechCrunch is that they have raised another $200 million in the form of a revolving credit facility from an unnamed subsidiary of a large life insurance company. And that is on the heels of a $700 million securitization that they got 3 months ago, which is another 4-year facility. So there's a lot of confidence in the institutional investors in Cabbage at this point.
But there's still questions. I think I saw another article about Cabbage, but there's still questions about that high interest loan type, quick loan, high risk, because a lot of these people are high risk and some are getting overexposed. Like, yeah, you see this theme happening, and so there's definitely risk. But obviously, people wouldn't be investing the money in it if they didn't think there was money to be made. So, well, depends on the due diligence.
I'm glad you brought that up, because an article in Accounting Today brings some concerns into my mind anyway about these types of companies. This is called CPAC Risks in Complex Financial Instruments and Derivatives. And it's summarizing a survey of CPA financial executives by the AICPA. And the highlight is that a 55% majority of the CPA business executives expressed concern about financial instrument valuations. And 59% of the CPA surveyed reported having complex financial instruments such as mortgage-backed securities, interest rate swaps, or other derivatives on their company's balance sheets. So a majority have these on their company's balance sheets, these derivatives, and 55% are concerned about their valuations. And the reason this is a big deal is because the whole reason we had the Great Recession was because of derivatives, essentially, that like nobody understood around the housing market. Mm-hmm. And what if, David, the next recession or crisis, it isn't derivatives based on housing, it's derivatives based on small business lending.
Because these are going to get packaged and repackaged.
Right. Like, so Cabbage goes and loans out $250 million to small business X, Y, Z. Or maybe it's less, right? It could be anywhere from a few thousand to hundreds of thousands. And then they package all those up into a basket of loans that's worth millions, or tens of millions or hundreds of millions. And then they sell that to an institutional investor. And, maybe this goes through many different layers, right? There's tranches of tranches. That's the way I understood that the housing, mortgages got packaged up and became a problem. And the more rounds you go through, the less visibility there is into the actual health of these loans, and they magically become A rated, and they're overvalued.
That's an interesting observation to tie that back to the housing crisis, because in a way, there was all these new mortgage companies. They were startups in a way, right? And they were not financially viable, and then they would package these up and sell them to more traditional banks.
Yeah,
right. And they would buy these, and you're right. Are they truly financing all these guys on their own, or is this being rolled up? That's a investigative job here. Somebody has to.
Yeah, and just like with the mortgage market, right? These new tech lenders are making the loans, and they're getting the securitization from the large institutional folks. Banks would never make these loans, or traditional banks would never make these loans. The tech companies are doing it. Not saying this is happening, but I could see how it could become a problem. I mean, especially if it expands beyond, let's say it's beyond small business lending, and It's just like individual lending becomes like this, where, instead of going to my payday lender down the street, I just do it on an app. And then that app is like repackaging all these tiny little $50, $500 loans and reselling like that. That would be enough volume to cause a problem, maybe.
I've had concern with some of the loan players a little bit, because I kind of feel like for a lot of small businesses, they might be doing it just to make payroll that week, or they might be doing it to get over a hurdle. Then next 2 weeks later, they're doing it again, and they kind of I could see them possibly getting a trap. But what's interesting is you have to step back and think about like, what's the motivation, right? So obviously Intuit has Intuit Capital, QuickBurst Capital, right? And obviously Intuit wants to make money on that and giving out those loans. But ultimately, Intuit just wants small businesses to be successful, because that's how they're really going to make their money, right? But if your app or your company only makes money off of the loans, isn't your motivation to give out as many loans as possible?
Well, yeah, especially if you are not holding the loans, if you're reselling them, if that, yeah.
So it'd be interesting to watch and see if that's happening. If any of our listeners are with one of these companies that are in that space, if repackaging is going on, I think it'd be great to find out.
I would love to know. So what else is new?
You know how going cashless has been on my
your beat.
My beat, right? Is going cashless. Well, Monopoly, our board game, Monopoly?
Yeah. Everyone's favorite game to play with your family to make yourselves hate each other.
But didn't you, like, when you were a kid, I imagine you probably like to be the banker.
Yeah. I loved counting the money. Yes, I did.
You had the money, you could count the money, you have the money in your hands. Well, it's cashless now.
What?
Monopoly's cashless.
Oh, God.
There's basically, the best way I could think of describing it, it's like an Alexa speaker in the middle of the board, and it's now called Monopoly Voice Banking.
Wait, where? I have to see this. I'm going to go to your link.
I didn't see there's no picture yet. I'm just imagining the way it's described, right? It's a speaker that's in the middle of the board, and it keeps track of everything.
I mean, but the whole point of the learning experience is in, knowing how to count the cash and keep track of how much you have and trade the money and all that. What do you do that? You do the transaction through the speaker or something?
Well, it's trading money. It's getting in fights with your siblings. It's changing the rules.
It's stealing the money, right?
That's stealing the money.
When somebody's not looking.
It's having free parking, like all these things that
maybe I'm just getting old, David, but I don't like this.
Yeah, so maybe we should have a poll. If people are,
we should do a Twitter
Monopoly
poll.
should have cash. Maybe people should try to save Monopoly.
Yeah, I'm generally in favor of cashless, but I do not support cashless Monopoly.
Now, with that said, though, like my kids on the iPad had Life.
Mm-hmm.
Life is so much easier on the iPad. You spin it up, you play it, you put it away, you're done.
Well, isn't that the dumbest game anyway in the real world? It's just you just roll and then you move forward and you collect money, right? There's no strategy.
You get to decide if you go to college or not. And that's the only decision in the whole entire game, I think.
Is it ever a good idea not to go to college?
Well, sometimes in the game, you have to change your career. And so you could go from being a doctor to a teacher, and then you're just screwed.
Yeah, it would definitely.
But I don't even know if you can be an accountant in the game of life, if that's a career. Maybe it is.
Well, that's when your life ends. When you become an accountant, so they didn't include it in the game of life.
That could be true. So remember last week we talked about MYOB had a crash?
Yeah, well they had that. They had that. Well, we're not going to call it a glitch because you didn't like that word.
Glitch, So anyway, it's down under news. Well, I have some more down under news.
Okay.
So the ATO, which is the
Australian Tax Office.
Right, Australian Tax
IRS
Office
of Australia.
The IRS. And they're very proud in general. They have their website, their MyGov website, and everybody goes to that and files their, they call it lodging for taxes. And so they're just a little bit steps ahead. Well, it crashed, right? And I'll read the headline from the the video article. It said, website fail causes tax return chaos. But that's not really why I'm bringing this up. What's really great about it, if you want to talk about it in that terms, is the way MyGov, their Twitter account, handled this. They just communicated really, really well. All tech companies should copy this. The IRS should copy this. They just were very polite might be the word. The way they handle it. They even address people by their first name. Hi, Fiona. Thanks for letting us know.
Oh, that's sweet.
There are currently some technical difficulties, including some people not being able to access MyGov. We apologize for any inconvenience. We are urgently investigating the issue, and we're working hard to fix this as quickly as possible.
Oh.
So we'll have a link in the Twitter thread, but it's really impressive that it's handled in that fashion. Very responsive to their chaos-causing crash.
Well, Wolters Kluwer should, be listening and take a page out of this playbook.
Yeah, absolutely. I mean, it's surprising that that's a government organization with that kind of decent service on Twitter.
Well, because everybody in Australia is very decent and polite, like it's just their thing. They're also friendly.
Yeah, and the thing is, though, they've been ahead, right? Australia's a little bit further ahead on cloud accounting. They don't write checks. So maybe this means the IRS will be tweeting like this one day.
Someday we'll have good customer service online from the IRS. That'd be great.
It'll be very impressive.
Well, hey, David, I got to get going. If people want to get in touch with us, where's the best place for them to reach you online? I'm
on Twitter at David Leary.
And I am at Blake T. Oliver. Follow us, tweet at us, tell us what you think. Tell us if we missed something, if there's something that we should include in our show. And we always appreciate reviews on iTunes in particular, because that's how the word gets out to folks. That's how Apple decides what podcast to put in front of you. So if you wouldn't mind doing us a favor, going into your podcast app, scroll into our page, and you scroll down, you find the spot to add a review. Give us a review. We will read it on the air.
You can find us on all the socials. So we're on Facebook and we're on Twitter and we're on LinkedIn. But good news, for those of you that are on the West Coast and you're in the LA area, we are going to be at the Accounting Show LA. Is it the Accounting and Finance Show LA?
Accounting and Finance Show LA 2019 at the Los Angeles Convention Center.
It's the 23rd and 24th
of July of this month. So we'll be there. That's in 2 weeks.
So some of you listening to this episode, it might be that day, that morning. Jam over and come see us. We're going to actually have a booth and we're going to do some shows on the floor in a real deal table.
We're going to record some panel discussions, right?
Yes, we got some. Hopefully we can get those locked down. And if not, come by. And if we don't have anything planned, we'll talk to you and put you on the show maybe.
All right. That sounds great. So that's the Accounting and Finance Show in Los Angeles, Tuesday, July 23rd through Wednesday, July 24th, LA Convention Center, West Hall. The show is free, so you should go and register at the link in the show notes, get your ticket, and you can get free CP and meet us. And we hope to see you there.
That's a plan.
All right, David. That's it for me this week. I'll see you next week.
Awesome. Bye, everybody.
Bye.